Hey, it's Rav, and welcome to the Everyday Investor TV show, the show that teaches you how to make money investing in real estate, investing in mortgages, investing, whether it's stocks, it could be anything. And remember, whenever you're faced with any type of investment, you always want to ask 4 questions. 1, what is the return on investment? 2, when do I get that return? 3, what is minimum investment amount that's needed? And 4, what is the risk? What is the downside? Super excited about today's show. We're going to be learning how we can make money. Wait for it. We'll be right back. On today's episode, we'll be talking to Sasha Cucuz from Graybrook Capital, learning how we can make money investing in land development.
Markets are made by people that are different with different objectives and all that kind of thing. So the thing with equity markets, to use that as an example, is that there's people that are in it for 6 months and they're trying to time things or news or whatever the case may be, earnings. It's almost impossible, in my mind, for a manager to be able to do that consistently.
Hey, it's Rav. Welcome back to Everyday Investor. Super excited about our guest today. Not only a friend, not only like a brother to me, but also a colleague. I get to work for his outfit. We have Sasha Cucuz on the show with us. Sasha, great to have you, my friend.
Always happy to be here, Rav.
Yeah, well, listen, I know you say that, but you're so busy. I mean, you're doing big talks live. You're doing other people's podcasts, and you made time for little old Rav to do this TV show. So thank you for doing that. And it's been a good 12, 13 years since we first met. And of course, I'm an aggressive investor with Graybrook. I know 10 different, investment vehicles, and I've done very well. And so a couple of years later, very grateful that you guys brought me on as kind of, help out with some business development and some exposure. And so it's just really been a fun ride. But you are not just a handsome face, you have a wealth of knowledge. And so that's why I want to talk about, kind of the state of the economy here in early 2024. But before we do that, talk just a little bit about Graybrook Capital and what does even that mean, capital?
Sure. Well, Graybrook as a company, so we invest equity. So that's an important distinction. We're not a lender. We are an owner, an equity investor in large scale development. So we focus specifically on residential real estate of all types. So everything from, the biggest apartment buildings to the largest master plan communities and everything in between. We operate and invest alongside best in class developers in places like Southern Ontario, most primarily, but also in various U.S. markets. And I think one thing that makes us unique is that the vast majority of our investor base is individual investors. We just felt from day one that this was a great way for them to be able to realize risk-adjusted returns that are very attractive and to participate in, the growth of real estate markets and the stability in real estate markets.
Yeah, when I tell people that I invest in land development, and they ask me the question often, Rav, you've been, your first investment was at 16 years old. I'm 52 now, so whatever that is, 35, 36 years. And they say, I would think that you would be well diversified. And when I tell them, no, listen, I'm invested with 5 different developers, different locations, a master plan community out in Fergus, and a high rise on a really fun street called Yorkville, to 100 townhouses in Woodbridge, Ontario. I mean, it's fun when I share that, and then they say, well, what about cash flow, Rav? Don't you want cash flow? And I say, yeah, but these projects exit at different times. And so therefore I get my, so it's very interesting. And people don't know. I mean, here you're sitting at Young and Bloor, and, in my opinion, and I'm not biased just because, I get to hang out there a little bit, but this is the Cadillac of investments. I mean, I get to invest passively and make returns north of 20%. You guys have almost 100 staff there, if not more, 10,000 investors over 30 different countries. So, sometimes when Rav and Sasha, or Rav and your co-founder Peter just kind of talk on TV, or we, extrapolate and put it on social media, people kind of just think, oh, okay, there's my cousin Vinny, rinky-dink little operation. No, this is, first in class.
Yeah.
And I know you don't like to big it up, but it's just kind of, there was an interesting story. Peter was sitting with an NHL hockey player, and somebody came up to both of them and said, wow, I love watching you on TV. And the hockey player thought he was talking about him. But no, it was Peter Politis. It's Sasha Cucuz, because again, this is.
I was there. I was there for that and saw it. And I also thought that she was talking about the player that we were sitting with, but she happened to see her on your see Peter on your show. So that's how she recognized Peter. But I think to your point, we think of this as a manufacturing business. And as you know, you're a real estate investor. You have been for a long time. There's different ways that you can do this and invest in real estate. And most often, people pursue active strategies where they're buying a property, they have to manage that property. Those are cash flowing investments. We simply think of this as a different way that you can access the market. So not only is the advantage that it's passive to you, the investor, we do all the work and our developer partners do all the work, but it's also a different part of the exposure, right? We think of this as you're in the manufacturing process. Right. So our raw material is land, right? We go and we buy land, we buy good land, depending on what we're building. And then we take that through a process. And ultimately, the end product is a unit that somebody buys. So for investors out there that are looking for diversifying their real estate holdings, this is just a very unique way to do it. And truthfully, as you pointed out, you can diversify within this strategy, because the things that impact the market for entry-level townhomes can be very different than some of the factors that might impact the market at the highest end of luxury condominiums. So there's always a need for housing, and that's one of the most fundamental things. And you and I always talk about this: is the thing about our strategy that gives it longevity is the fact that you are producing a widget that everybody needs at the end of the day.
Yeah.
Right. There is no ifs, ands, or buts about it. Whether you're buying it or renting it, people need housing, and we have a shortage of housing, most definitely in Southern Ontario, but in other markets that we operate in as well.
Yeah. I think what really boggles people's minds is when we're looking at these finished products that cost $300, $400, $500 million, to construct on. And yet somebody can get into these investments for as little as $25,000. And so, Rav and friends would invest, and, my one friend might invest $500,000 and another friend, $100,000. And then Sasha says, hey, Rav, you can come in for $25,000, and I can use registered funds in most cases as well. And so, no, you've really done something where, a lot of companies might talk to an institution or a pension fund, which I know you do as well. But you've opened it up to the everyday investor, so to speak. And so how did that get birthed? And after we talk about that, I do want to talk about your thoughts on the economy today. But, how did that model come into play where you allow everyone to play?
That's a great question. I would tell you that there were two steps to it. Step number one was when we made our first investment, Peter and I and our other partner, Elias, at the time, into a development deal. We raised some money alongside us. So logically, nobody thinks about going to speak to 10,000 people and, that kind of thing. You think, well, I'm going to go to the big check writer and the institutional capital. But at the time, we didn't really have the track record or the history. And this wasn't an area that institutions had a lot of experience investing in, right? Development was very much a bit of a black box industry as it related to capital markets, right? Companies raise money all the time, right? They raise equity markets, they go to debt capital markets. Real estate development, less so. So truthfully, couldn't attract institutional investment at the time. We didn't have the track record. So where did we go? To friends and family that trusted us enough to put their money alongside ours, right? We invested our own money in these projects. And at the end of the day, when we had success in doing it, we learned something. And the thing that we learned was that why why does it have to be institutional capital and pension fund managers? Why can't individual investors have access to, what we feel are unique opportunities that they can't just stumble across, right? So we just kept going down that path. And today, as you point out, we manage $2.5 billion of equity and $40 billion of development. So it's a big portfolio, and we have institutional capital. But the heart of our business and the sort of the heart and soul of the business has always been working with individual investors, and we're uniquely equipped to be able to do it. The way that we're structured, the way that we can help discover an investor's objectives, help them diversify, and build a portfolio that will perform well in the long term.
And what are we shooting for? Obviously different projects have different returns, but what do we generally shoot for a projected return on an annualized basis? Because again, we're manufacturing something. If it was, your nice dress shirt that you're wearing, probably we could get a return in however long it takes to make a dress shirt. But we're talking about master plan communities or 3 or 4 condominiums or, here in the Golden Horseshoe or South Florida and different places. So these can be 4, 5, 6, 7, 10, 15-year deals. So on an annualized basis, what do we shoot for, Sasha?
Yeah, the easiest way to describe it is we shoot for kind of a net 20% annualized to the investor. And as you point out, depending on what it is that we're building and over what period of time, usually it's, I make my investment at the beginning, and then when all is said and done, that's when I get the profit. And when you average that out over time, it works out to about 20%. So we always say internally, our goal is to double our money every 5 years. Right. So if you're doing a project, for example, that's 10 years, then you should be able to double your money 2 times over that period of time. So it's always kind of shooting for that 20% net return to investors. That's after the success fee that we earn for successfully managing to that 20. It's after the, what the developer earns for the money they invested in the work they've done. That's kind of what we target on a net basis for our investors.
Yeah. And like I said, I started as an investor and continue to, and 10 different investments. I've exited 5, and I have made north of 20% annualized returns by writing a check. And again, somebody can invest as little as $25,000 with registered funds. And no, it's really, really, really is great. So here we are, in 2024, and what are we thinking? Because it's not, you're very smart. You have a very smart team. You employ very smart people to, assess deals. In other words, underwrite the deals. But you're also surrounded with big economists, and you sit with big economists, friends with the Benjamin Talls, if you will. What is the sentiment, Sasha, here in 2024 when it comes to just anything economics? That's your background. It's not just development. You have a background in economics. But yeah, what are your thoughts there?
Yeah, I think that we've gone through over the last few years a bunch of unknowns, right? It started with the pandemic and everything that meant to our country, our economy, the global economy. It was there was no playbook for what exactly was happening, and the consequence to that was governments and central banks having to do a number of different things in order to be able to do what was required to keep people going, to keep the economy going. When things sort of started to come out of that, now you're dealing with the hangover of what that period of time meant. So as things normalized kind of post-pandemic, we had gone through supply chain challenges. We had gone through all these things that all of a sudden were starting to relieve themselves. And now the economy had a lot of liquidity in it, a lot of savings built up. So of course, what does that do? It stokes inflation, right? People have a lot more cash. They can go out and they can spend. And of course, that's going to drive, when you take that in combination with the scarcity of things that was caused by the pandemic, that dynamic of scarcity with abundance on the liquidity side obviously pushes prices up, and that puts the economy in a very compromised position, because inflation is a very dangerous thing in an economy if it becomes entrenched. So obviously the reaction to that is governments and central banks had to kind of tighten the reins again. And what that means is increasing interest rates to try to take the liquidity out of the economy again. And that's kind of what we've been living through. Now, the pace at which this has happened has been very difficult for most people to manage, not only businesses, but individuals. So when you put all of that together, we're in a position today where I think that we're largely through interest rate increases, because as you've seen these in, people that follow the economics, they can see that the inflation numbers have started to come back into line. We might not be completely under control yet, and this necessitates the Bank of Canada here in Canada to maintain interest rates at their level that they're at today, probably for a little bit longer than people would like. But at the same time, this is doing us a long-term service in the way that we manage our economy. So there's going to be a period of time here where we're going to have to kind of stay, hold steady, batten down the hatches a little bit longer before the Bank of Canada is satisfied that inflation is adequately under control, and then they can start reintroducing some stimulus back in the economy. What this means, I think, for us as a real estate investor is always, I've been doing this for 20 years with my partners and people here at Graybrook, and it's rarely a straight line. And that's just the reality. Whether today's problem is inflation, yesterday's problem was policy, and before that, it was the financial crisis. And there was a whole bunch of things in between. So you just learn to kind of manage it. And the one thing as a real estate investor that we always hang our hat on is real estate's inherently a long-term asset class. You're not buying real estate for the purpose of, realizing a gain in 5 months or 6 months or even 12 months. Usually you're buying something and there's a window that is many years oftentimes where you're a holder of that real estate, whether you're value creating like we are in development or whether you're buying something to just hold it. So you have to kind of take a bit of a longer term perspective. And part of the tricky thing to do is to kind of look at what's happening today and not let that just cloud your judgment of what's going to happen in the future. You have to kind of get a little bit outside of that and understand the dynamics in the economy and what has led to this particular point in time, and the things that are being done. And are they going to last a long time, or are we going to see a period of more normal conditions? And, I'm a believer in Canada and the Canadian economy. And I know that in the housing market, we have a challenge. And that challenge is that we have a significant shortage in housing relative to our population growth and relative to the need. So when you start off with fundamentals like that, where you have a lot more demand for your widget than you have the ability to supply your widget, that usually gives you stability in any business, including the production of housing. Now, you have to navigate different paths. You have to navigate complexities. You have to navigate the macroeconomic conditions of the day. But if you take a long-term time horizon and you don't structure yourself in a way where you're buying something with too much leverage and then your costs are too high, if you're very intelligent about the way that you're moving forward with acquisitions and developments, then it's just a question of being patient and watching things unfold. And eventually, I do believe the fundamentals, as I said, that exist are not something that are going to just change overnight. And I do think that we have the dynamics in our economy that will allow us to be successful and prosperous as a country. And we just have to kind of get through the next, whether it's 6 months, 12 months, 18 months, whatever that may be. We're on the side of things are starting to get better, not worse. So I'm very optimistic about what we're going to see in the future. It's not, the work isn't done, but I think we're on the right path.
Yeah. No, I love that you mentioned, especially the long term. I mean, human nature is to want it now, right? I mean, listen, Sasha, I don't even know how to cook, bless my wife, because it takes longer to cook it than it does to eat it. And I just, but that's not good. I'm confessing to my brother. It's human nature to want things quick. And when it comes to making money, I have learned from you, and your outfit, that it takes time. Are you in something like this for the long run, or are you trying to time the market, which is ridiculous? And but it's almost like it's human nature. Tell me now, and I want the short. Even when I talk to people about Graybrook, I've done a 2-year townhouse project, and it's fantastic, but my biggest gains, is in a 15-year project, because over the long run, when we're talking about manufacturing real estate, God's not making any more land. It goes up and down upwards. And so you're going to make money. Now, don't get me wrong. Still fantastic. The 2-3 year, if we're going to build 100, 200 townhouses, so on and so forth. But touch on that for a second. Just the psychology of not wanting to be in. There's a great book by Darren Hardy, highly recommended. It's called The Compound Effect. And whether it's, me eating a burger and fries for a month or having a salad, you're not going to notice until maybe a year out the difference, or going on a date with my wife once a week. I'm not going to notice the quality of my relationship right away. But if I do go on a date as opposed to not. And so it's the same when it comes to investing, especially investing in real estate, land development, etc.
Yeah, listen, Rav, I agree. I mean, I say it all the time that the psychology of markets is such that, sometimes markets are made by people that are different with different objectives and all that kind of thing. So the thing with equity markets, to use that as an example, is that there's people that are in it for 6 months and they're trying to time things or news or whatever the case may be, earnings. It's almost impossible in my mind for a manager to be able to do that consistently. Like, you might be able to get it right on one stock or whatever the case is, but you're not going to get it right enough. And that's not me saying it. Look at any data and look at the index, for example, which is the best, broadest indicator of just general investment performance over a period of time. There's very few, if any, managers that can beat the index over the 10 or 15 year period, right? So that just tells you right there that the ability to pick is very difficult to do. So all of this to say that real estate is even more so difficult. And that's because real estate is much less liquid than stocks, right? So at the end of the day, the illiquidity that's inherent in real estate, like when you buy a house, as a perfect example, and you just want to sell the house, it doesn't take a day, it doesn't take a minute, it doesn't take a second. It can take 90 days, right? Like, so that in and of itself is a stickiness to this asset class. So in my opinion, you have to think about it as a long-term investment. And when you look at the fundamentals like we do, the thing we focus most on are these dynamics. And sometimes I sound like it's so elementary where I'm talking about supply and demand. And of course, it's more complicated. You got to manage costs. You got to manage budgets. You got to manage policy. There's a million different factors. But just at a very basic level, you are providing something in this industry that is very, very required. And there are many more buyers than there are ability to produce what you're building. That in and of itself as a fundamental premise is a fantastic fundamental premise as an investor, right? Because it's going to lead to consistency and stability. The thing that's hard to predict is what happens quarter to quarter with interest rate policy. Oops, a pandemic happened. Like, those things are unpredictable. So if you look at a chart of, let's say, housing in Toronto, and you look at that chart in a very short window from 2019 to 2024, that chart will look like it's very volatile, right? Like, it was here and then it went up and then it went down. Wow, that's a lot of volatility, right? And the things that precipitated that were like pandemic, supply crunches, interest rate shocks, all these macroeconomic factors. Now, if you zoom out and now look at that chart over 20 years, what you're going to see is a very defined upward trend. And if you look closely, there's going to be volatility and little bits of volatility everywhere. Now, imagine your strategy was to try to pick the ups and downs in that very narrow way, as opposed to just looking at it and saying, look, I'm buying here, and that my strategy is to hold on to this or manufacture it over 5, 7, 10 years. Now it's much less volatile. Now you're zoomed out and you're looking at that upward, very defined fundamental trend. So that's kind of how we think about it. And it's difficult sometimes for investors because we're human, right? We respond to news. You get scared, you get nervous, you get excited. All of those things happen, and that leads people to act. Whether it's act like, man, I got to buy now, or whether it's act like, oh my God, I got to sell now. It's hard to just say, I have to do neither of those things because I'm in it for a period of time. And I know that based on all the fundamental dynamics, I know where we're headed. And, the best investor in the world, not in the real estate sector, but everybody would know Warren Buffett, I was watching an interview with Warren Buffett, and the question was asked, you're the most successful investor of our time and people follow the things you do. And I can't remember the phrasing of the question, but it was something to the effect of him saying, if I had done none of what I did, buy company, sell company, hold company, inject cash, take cash out, run an active business, if I had done none of that and just put an amount of money in on day one and just put it in an index fund over that period of time, I think I marginally outperformed in his active strategy. And he's like, was that worth all the 100-hour weeks and, all that kind of thing? Probably not. But that just shows you that over the long term, the prosperity of the market, the prosperity of the economy, right? It's all a question of like, what's your time horizon and reframing the perspective.
Yeah.
My opinion.
No, you're bang on. I mean, people ask, every sector seems to be, scary. And people ask me, Rav, how's land development? How's Graybrook? And I'm like, yeah, but you're missing the point. I mean, what do you mean, how is it? Because when I invest today in the manufacturing of a condominium or, a bunch of detached homes or townhomes or even buying an apartment building, it's not 4, 5, 6, 7, 8, 9, 10 years later is when I get to reap the fruit of my investment. And so are you asking me, what do I think is the market's gonna look like 7, 8, 9, 10 years? I'll tell you what, it's gonna go up and down upwards. Listen, Sasha, it's been great talking to you. Time's up. Give me 30 seconds, a minute of kind of your closing thoughts. I love investing in land development. I love investing with Graybrook. Like I said, 10 different projects, exited 5. Thank you for your hard work. I don't have to walk around with a hard hat and a hammer. I just, invest passively. But kind of your thoughts for those that are watching and maybe a little fearful. And, I think you've put people at ease a little bit, but just some kind of closing thoughts.
Yeah, I think as I pointed out, I mean, we will look at things not day to day and quarter to quarter. We do when we're doing the work because, I don't want to take it up to this cosmic level and suggest that there isn't like a lot of complexity that you have to deal with day to day, week to week, month to month. But ultimately, the investment strategy is one that has withstood the test of time. So what I would always say to people when you're thinking about getting involved in a new strategy is take the time. Take the time to do diligence. And when you do your diligence, I always say, do your diligence on the people and the people that you're giving your money to, because ultimately they're the ones who control the investment. A lot of time people like to focus on like, okay, it's this property. Let me evaluate this property. And you could, and you should. But at the end of the day, the people that are making the decisions, the people that are the ones that are in control of whether this thing succeeds or fails, and that's who you need to spend your time. Understand who they are, understand their track record, do that diligence, understand their infrastructure, their capability, their reputation. So whether it's this type of investing or any type of investing, it's all about execution, and it's getting really, really comfortable with the execution.
Yeah. No, perfect. And even when you're doing that due diligence, if they've only been doing it for a year or two, also be careful. Look for a long, kind of track record. Listen, Sasha, thanks for taking time out of your busy day for me. And for the viewers, it's been great having you on the show.
It's a pleasure. Thanks, Rav.
Yes. And thank you guys for watching. Without you, we would not have a TV show. Make sure you visit everydayinvestor.com. There you can sign up to our letter that sends out all different types of investment opportunities. Thanks for watching. We'll see you next week. Same place, same time. Honey, I love you. I'll be home soon.